Welcome back to the channel, fellows. So as you know by now, on this channel we give valuable information on finance, on investment, as well as personal growth. If that sounds good to you, kindly log in to this channel. So without further ado, let's jump into today's topic. So we shall look at 4 types of investment funds for people that have lower risk appetites and new investors into the stock market. So look at 4 funds that are very secured, low risk. You don't have to break a sleep. You know that to a large extent your funds are secured. So we look at number 1, mutual funds. A mutual fund is a pool of investors' money that is invested broadly in a number of securities. Mutual funds can invest in a broad array of securities, equities, bonds, commodities, or currencies. But note that there is typically a minimum amount that one can invest in a mutual fund. So for Naira mutual fund, the minimum amount is 1 million Naira, while for a dollar mutual fund, the minimum amount is $1,000. So the interest rate in real time fluctuates, but recently is at an average of 20% annually for Naira mutual fund, that is. You get your interest paid daily, that is withdrawable at the end of every week. The risk is relatively lesser because the investment is diversified, is very diversified. Mutual fund typically spread its investment across different assets. It spreads it across different asset class. As I said earlier, it could be bonds, it could be commodities, it could be in the money market, it could be currency, it could be securities, it could be equities. So it's well spread. So that gives it a hedge against unnecessary risk. So mutual funds are actively managed. There's usually a team of fund managers choosing which assets to buy and sell, trying to beat the market ultimately. So as a result of the funds being actively managed, it attracts a high fund manager's fee, and interest is charged on every withdrawal. This could range from 0.5% to about 2% annually, depending on the asset management company. The fund managers apply special strategy to try to outperform the market essentially. So they can use their wealth of knowledge and their experience to know the period at which the market is in bull and the period that the market is in bear. So they can come in and go out of the market as they will or as they know. So example of mutual fund include in Naira, like our Naira mutual fund, we have the Stanbic IBTC, we have the United Capital in Nigeria. So in the US, we have the likes of Vanguard, we have the likes of Schwab. So they all offer a wide range of funds, both actively and passively managed. So whether you want the one that is actively managed, that is basically what mutual fund is for. So they have you covered. There are different types of them. Just with one company, they have different types lined up. So number 2 funds that we'll be talking about today is exchange traded funds, ETF. So these are also a collection of stocks, investments that track a particular index. Shares of ETF are bought and sold on the stock market. Their price fluctuates throughout the trading day. Just like mutual funds, ETF are often managed. So just as we have mutual funds, ETF is highly recommended because they are more diversified than holding individual stocks. You can make money from ETF by selling it at a gain value or earning dividends. So there are some ETF too that pays dividend to its shareholders, to its investors. So it is not only when you own an individual stock that you earn dividend. While holding an ETF, you can also get paid dividend. ETF is passively managed in most cases, so it has low expense ratio fees which is charged yearly, and they just follow the index to track a particular sector, industry, or market as a whole. So on ETF, you track a particular industry. So be it tech, be it manufacturing goods, be it agricultural produce, be it pharmaceuticals. So all those sectors, they have ETF on each industry. So if you have a particular industry that is of interest to you, you can follow through with that industry and have an ETF, have a whole basket of stocks on that ETF that you feel that will perform better over a period of time. So you could have basket of stocks in a particular industry that you feel and you know that will perform better in the long haul. Its expense ratio ranges from 0.03 to 0.2 annually, that is. So you can see that in the long run, when you compare mutual fund to ETF, the fee is relatively cheap for ETF than mutual fund because it is passively managed. So examples of ETF are, in Nigeria we have the vet goods. These are fast-moving consumer goods that you can invest in Nigeria. We have in the US, we have the QQQ for tech stocks. We also have the STRAB, the ticker symbol SCHH for real estate, ETF. We also have New Gold for gold stocks. We have iShares for the crypto industry. So if you have interest in any of this industry, be it the crypto, be it gold, be it real estate, be it consumer goods, be it tech, there are ETF that could cater to your wants and your demand. So I want to hear from you in the comment section, please. Can you talk to me about which of these 4 funds is suitable for you and for your investment style? Which amongst them? Is it the mutual fund? Is it the ETF? Is it the index fund or the hedge fund if you're an elite, that is? So talk to me in the comment section. Let's know. Let's discuss in the comment section. So the third fund I want to look at is called index fund. It is a type of fund that does not try to pick winning stocks. I would say this fund is the most popular amongst the elites because they don't want to stress themselves. They don't want to think about it. They just have their money for wealth retention. So at least if you have your money in an index fund, it could hedge against inflation because as there's inflation, there's increase in the value of your shares with that company. So index fund just follows an index. There is no one picking the stocks, so that keeps it at a very minimal fee range. They charge an annual fee called expense ratio that is super low, ranging from 0.02 to about 0.1, depending on the company and depending on the particular index. So you can see that its fee is very low and it's being managed passively. There's no activeness. There's nobody picking the here and there. It's just following an index of a particular class. So index funds are priced once a day, and that is after the close of the market. So if you are pricing a particular fund, you cannot execute it until the close of business for that day. So it is the rate that the index fund falls on. That is what will trigger the price with which you can buy with. So you can't just price it at any point in time. When you want to buy, just know that it's at the end of the trading period or it's the end of that day, that business period, that your buy order can be executed. Index funds are passively managed, needing no strategy to outperform the market. It just goes on its own. Example of index fund is the S&P 500, which is the top 500 companies in the United States. So the index is the size of the companies. So the benchmark for picking the stocks that makes up the S&P 500 is the size, how big the companies are. So the top 100 companies in the US makes up the S&P 500. We also have the Dow Jones. This tracks the top 30 companies amongst different industries. We also have the Nasdaq, which tracks top 100 tech stocks in the United States. So if you are looking to acquire tech stock, if you believe that tech stock will outperform every other sector and you don't know the particular one to pick, you can just buy a Nasdaq index fund and that would take care of the headache for you. So the last fund that we'll be looking at is the hedge fund. So the hedge fund is a private investment fund that pulls money from wealthy individuals and invests them in a wide range of assets like stocks, bonds, currency, derivatives, and the likes, etc. Hedge funds use strategies like leverage. They can use leverage. They can short sell. Leverage means you are using your fund to borrow additional funds to trade so that you can maximize your profit or your earnings. Why you have short selling is when the market is going down. During the bear market, you can speculate that the price will fall further And if your speculation goes right, then you stand to profit very much as the market is going in your expectation. They inculcate so many strategies in their investment style just to have an exponential increase in their earnings or profit. They are actively managed by fund managers and they aim for much higher returns. But also, there's large volatility because, as you know, you cannot completely predict the market. For the most part, you may think that you are getting it right, but before you know it, something unexpected can just happen. It could lead to losses. So the fees of hedge fund is always the highest as it requires highly skilled fund managers to be able to profit. Hedge fund is an elite investment class. So hedge fund cannot just be set up for the public. They are elite group of people that comes together, hire a fund manager, a very skilled one at that, so that they can exponentially increase their work or sustain it at the least. What we have seen from these 4 funds is that these are pool of money from different people used to invest in a variety of assets, be it stocks, real estate, bonds, currencies, derivatives, etc. So instead of trying to manage each individual asset yourself, these funds can handle it for you in the best way possible. So saving yourself the stress of watching the stock market every now and then, you can have one of these funds. It will increase and sustain your wealth. So I want to believe that you've gotten value from this video. So kindly do me a favor and smash that like button. Please hit the like button, subscribe to the channel